Hi everyone, welcome to the next video in the series of long-lived assets, wherein we are going to talk now about a very simple concept called as the impairment. If you recall, we've already spoken about impairment perhaps in a little more business-like situation long ago when we spoke about the Baron Coburg case, wherein um, I recall the farmer Ivan who had broken his plow beyond repair. And at that moment, we said the total consumption by Ivan during that year is broken down into two pieces. One is the usage part vis-a-vis the breakage part. So this particular topic of impairment is largely to focus on that breakage part, right? So it's going to be very simple concept, very short concept compared to the longer concept of depreciation that you've done. So here it is, people. It is let's keep it very simple. Whenever you see any of your long-lived asset losing their value for reason beyond the usage, beyond wear and tear, that's where impairment kicks in. And impairment is not a very technical word. So we see, unfortunately, some people not being able to walk properly. So we say they are physically impaired. We see some people are not able to hear, speak. These are all physical impairment, mental impairment, mentally, challenged. So basically impairment means unable to function as designed. And in a business-like situation, for a business asset, there could be various situations where your asset might not be able to function the way it was perceived, for which it was bought at the first place, right? So people, why impairment? It is one of the external reasons. Of course, it's a big loss. And I want to differentiate that in context with depreciation as a reference point. There are good amount of similarities and there are good amount of differences. So allow me to bring the similarities with depreciation first. Both impairment and depreciation leads to fall in the value of the long-term asset. The fall in both the cases hits your P&L account. So that's another similarity. And since the P&L account, therefore the equity. So A is equal to L plus C, asset go down and therefore equity goes down. And then corresponding impact on ratios is also similar. Both are operating in that sense. So a lot of people think that impairment loss is a non-operating thing because it's non-frequent. No, it's absolutely related to your main assets, the business assets, therefore absolutely hits your EBIT and therefore operating. The difference, on the other hand, one more similarity I missed, both are non-cash. So A is equal to L plus C. That's the corollary actually. That asset go down, you don't have to pay cash to anyone, and then your P&L goes down. So I don't want to bring up the cash flow statement, the indirect method right now, but they have similar treatment wherever they go. Okay, be it in a cash flow statement context or in case of any ratios or anything like that. So these are all similarities. Now, coming to the differences, people, differences is something that is very critical to note. The first and the most important difference is depreciation is a desired thing to happen. I want my assets to be used. It's okay if they are getting older, but the reason is that they are getting used and therefore getting older. On the other hand, impairment is actually an accident. Impairment is actually a loss. So while depreciation technically is an expense, impairment is a loss. If you remember one of the slides that we did, value outflow can take three forms. If it gives you no benefit, it's a loss. If it gives you benefit which has already been consumed, that's an expenditure. So that's broadly the difference, one of the major difference between the two. The second, and again an important difference, is depreciation is a planned thing. You can plan a depreciation. You have a production schedule, so you can see how much an asset is going to be used. Impairment is an accident. You can't really, plan these things. And the third, again, difference is, and again from an MBA standpoint, more from an analytical standpoint, depreciation is a sustained fall in the value of the asset. On a particular day, you're not going to use your machinery for 24 hours, and on a particular day you won't use it for just 1 hour. It's a sustainable fall. And whereas impairment, like every other accident, is a blip. It's going to happen on a day. It's not that every day your mobile phone is going to fall off your hand, right? So let me just give you some of the business situations where you can figure it out as to how can, in that context, your asset will become old. So these are some of the situations, and by no means I mean to say that these are the only possible business situations. I give you these four situations, people. Change in the business environment, and I've given you the context, practical real life examples as well. So in various cases where GST regime was implemented, a lot of businesses who were uh, erstwhile outside the net of excise and things like those suddenly came into the tax net. And imagine a business need to pay 18% GST, whereas the operating margin was 10%. So suddenly the business is unprofitable, and the businessman, while looking at the business assets, will not be able to use them profitably. So the value of those assets which were able to generate a return of 10%, now under the GST regime, suddenly the business environment has changed. I could put here the situation of COVID as well. Okay, now whenever such a mega disruptive change happens in an environment, you might find some of the assets becoming absolutely worthless. That loss of worth is because of not the usage or depreciation, but because of a one-time accident. That's impairment. Second could be the decline in the usage rate. I've been part of Maruti Suzuki in 2005 to 9. At the time where Tata Nano got launched, and therefore the press and the dies which used to manufacture Maruti 800 were tested for impairment, because we thought that Maruti Suzuki was making the people's car. But after Tata Nano took that position. From a two-wheeler, if someone has to graduate to his first car, earlier it used to be an M800, but then became Tata Nano. So we were just a little afraid at that moment that would we use our polar position? Thank God we did not. What I'm trying to say is that the imagine if that would have happened, then the assets which were making M800 would be used much lesser, because the demand of M800 would have gone down, and therefore because the decline in usage rate, the future benefit from those assets, the long-term assets would have come down. And that is again one of the reasons, which is like an accident. Not every day that your competitor launches such a disruptive product. Then it is a significant decline in profitability. Nokia is a classic example, and you can have many, many examples here where your assets are getting used to produce a particular kind of an inventory, which is, you couldn't pick up the trend, and that changes. Same happened with AquaGuard. AquaGuard industry thought that the RO, the reverse osmosis system led by Kent ROs, and there are now hundreds and thousands of varieties of RO. Now no one buys AquaGuard. At least the younger generation doesn't buy AquaGuard, and everyone's like, okay, fine, 25,000 rupees, okay, and 8,000 rupees per annum is the maintenance, but let's have the fresh water to drink. So that's a change in the lifestyle that has happened. So this industry is now impairing the assets because there is significant decline in the profitability. And fourth is, again, an exceptional situation where point is, again, there could be another reason that, your raw material has suddenly become very expensive, and therefore producing the inventory from this long-term asset is no more profitable. But the long story short, again, is that as a business, I don't want to use this asset anymore because it doesn't give me as much profitability. And since I don't want to use it anymore, the future benefit that I as a business see in this asset has gotten reduced. And that reduction is the impairment loss. Okay, the technical definition that you might want to keep into mind is the recoverability of the book value. The carrying amount is actually the book value in the balance sheet. Whenever you write an asset at X rupees, you're telling the world that you want to derive the benefit of X from this asset in future. When that X becomes, let's say, 0.8X, the fall of 20%, for example, that's an impairment loss. So, and that fall might happen because of any of the four reasons that you see, right? So people, impairment, like I said, is somewhat related, but largely, could be differentiated from depreciation. Keep that difference in mind. You never know. One day it might really make a difference while you're comparing the two companies. In both the cases, the assets have gone down by a same amount, but in one case it's depreciation, in the other company case it's a impairment. I may want to buy the shares of the company who is experiencing the depreciation rather than impairment. Although on the face of it, the both might look exactly the same, fall in the assets and fall in the equity through P&L. Okay, so these are the smaller things that a manager got to keep in mind. Okay, pretty tight, small concepts. Looking forward to speak to you in the live class on that.